Hello and welcome back to the next video in the FX Evolution trading course. Today we're going to be taking a look at more detail of how to analyze trends from a price action standpoint and also how to analyze trend lines correctly. It's really important to understand these concepts because they make up the fundamentals of how to trade the market. So let's define trend using a series of highs and lows. This is what we call the first time frame. So when we see price in the market moving upwards and down, it ends up making a candle or a bar over different time frames. Let's say we had like an hour time frame. Here we have an hour candle or bar, and we can see that it has a high point and a low point. Now, for the definition of a first time frame, what we want to see is a series of higher highs and higher lows for an uptrend. So we want to see each consecutive candle or bar for each consecutive hour making a series of higher highs and higher lows. We can see that here. A high, a low, followed by a higher high, a higher low, a higher high, a higher low. This makes up what we call the first time frame of trend. And it's all relevant to the actual hour or the actual chart that you're looking at. So whether it be an hourly, a daily, a 5-minute, you can do the same analysis to correctly identify the first time frame in the market. For a downtrend, what it is a series of highs and lows followed by a consecutive series of lower highs and lower lows until eventually the sequence is broken and we see a higher high and a higher low. And for an uptrend, we'd have to see a lower high and a lower low to break the sequence of the first time frame. So if you're looking at a candle chart, this is how the first time frame may look for an uptrend and a downtrend. We can see an uptrend, a higher high, or a high and a low, followed by a higher high, higher low, higher high, higher low, and so on. We can then see that if this trend did continue and then eventually made the final bullish higher high and higher low, then followed by a lower high and lower low, that would signify the end of the first time frame uptrend and the beginning of the first time frame downtrend, which would be a consecutive series of lower highs and lower lows, as we can see here. By understanding the concept of first time frame price action, we can actually paint a larger picture of what's happening in price. We can see that if we can analyze those first time frame downtrends and uptrends, overall, they paint a picture of what we call a second time frame and defining trend using a series of peaks and troughs. So if we had a downtrend followed by an uptrend, followed by a downtrend, followed by an uptrend, you can see how we've got a trough followed by what we call a peak, followed by a higher trough, followed by a higher peak. And this makes an overall picture of the swings within the market. So after we analyze these series of peaks and higher troughs and higher peaks, we know that it's in an uptrend. And usually what I like to see is a trough followed by a peak, followed by a higher trough. And when this first peak is broken, that's my confirmation that we're in a second time frame uptrend in the market. And I might look at potentially purchasing in the market at this break if I'm given other signals as well. For a downtrend, it's a series of peaks and troughs followed by lower peaks and lower troughs. So first time frame downtrend, then first time frame uptrend, followed by first time frame downtrend, uptrend, etc. It's quite a difficult concept to understand, but when you do fully understand it and you start reading price this way, you actually understand how trends work and how to correctly identify them. It's a very, very important concept. So let's take a look at how the definition of using peaks and troughs on the second time frame can look on a line chart. So here we have an uptrend. We can see that price has come down for a first time frame downtrend, then it's reversed and gone up. And when it breaks, when it reverses and starts up, we can see that we can now draw the T for trough. We then have a peak followed by a higher trough, followed by a higher peak, followed by a higher trough, and so on and so forth. As long as we continue to have first time frame downtrends and uptrends, where the downtrend or the trough is not as large as the previous trough, we are in a second time frame uptrend. So as long as it's always a higher trough and not a lower trough, we're in the second time frame uptrend. Now for a downtrend, it's a peak followed by a trough followed by a lower peak, lower trough, lower peak, lower trough, etc. And this signifies the second time frame downtrend overall. Because we now understand second time frames, we can now understand how to correctly analyze trend lines in an uptrend and downtrend. So here we have a trend line of a series of them on the market. We can see here it's a trough followed by a higher peak followed by a higher trough, higher peak, higher trough. At some point we can draw this as a trend line. So we can draw, let's say, a green line here, which is following the series of higher troughs. Now what I like to do is I like to see a consecutive amount of touches before I analyze this as a trend line. So we need to make sure that we have hard, fast rules as technical analysts. So a trend line is dynamic support. And when it comes to trading them, what I like to look at is after we've got two troughs, so a trough and a higher trough, and then we have the second peak, this is where I'll draw my trend line. And after price comes back down and forms a higher trough and then breaks this second peak, so here, that's when I know the trend line is verified or validated. So I'd be looking at potentially buying each high trough area as it comes down to my trend line with the idea of profiting from the increase in price over time. For a trend line in a downtrend, what I'm looking for is the exact same thing, but the opposite way around. So a peak followed by a lower trough, followed by a lower peak, followed by a lower trough. The same principle applies. So as I see the second peak being formed, I'll draw my trend line, and when that second peak gets broken, so at this point here, I'll know that the trend line is validated. So we've had three troughs and we've had two peaks at this point. So when it breaks past that second peak, we know that the trend line's validated, and we can look at when it comes back to the trend line, potentially selling the market at this point with the idea of decrease in price over time. If we do this, we'll have hard, fast rules, but this is the most profitable way to trade trend lines correctly and not get caught in the trap of incorrectly drawing lines just for the reason of drawing them. It also helps us to actually stay away from non-trending and ranging markets. So by being able to analyze price using peaks and troughs in the second time frame and analyzing price through first time frame, second time frame dynamics and having those hard, fast rule for trend lines, we won't get stuck as much in non-trending ranging markets. That concludes the video for today, and we'll see you in the next video.